Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, trade turmoil is still on the agenda, so will our economy remain unscathed? And there are glimmers of hope on the affordability front. Plus, a Canadian company marks an important space milestone. That's all ahead. First, for the week that was in business, it's time for the briefs. As the powerful gathered at an annual meeting in Davos, Switzerland, Prime Minister Mark Carney delivered a blunt message. The old world order is officially dead. As such, middle powers like Canada and its European allies need to chart a new path that does not rely on a benevolent U.S. to safeguard trade or security. It came as U.S. President Trump was ramping up talk of acquiring Greenland and threatening new trade sanctions on the EU. Ontario Premier Doug Ford continued his PR campaign against Chinese EVs this week. That drivers in such vehicles might be spied upon by Chinese listening devices was a warning. He also said the current deal is only for 49,000 vehicles, and though that's a thin edge of the wedge, and at that present rate is a sizable chunk of EV sales. Headline inflation ran hotter than expected in December, up 2.4%, but some core measures tracked closely by the Bank of Canada showed a decline. The overall number included some distortions related to year-ago reductions in GST in some categories. The core measures are now actually below the bank's 2% target, but many economists still believe the bank will hold rates where they are for now. Quarterly surveys from the Bank of Canada of business and consumer sentiment were a mixed bag, with some signs of resilience for business, but a more cautious consumer anxious about the job market. While many businesses are quietly optimistic compared to the last survey, they're also making plans for layoffs in the year ahead, with 1 in 5 looking to shed workers. Thousands of federal employees received notices that their jobs may be on the line. That's as the government looks to shed $60 billion in cross-department costs and reduce the public service by about 40,000 people. Some 10,000 jobs have already been eliminated. One union representing government employees noted that spending on outsourced consultants rose last fiscal year to $19 billion. And those are your business briefs. Global markets had plenty to digest this week, with new threats of trade turmoil balanced against a more optimistic outlook for growth driven by new technology like AI. Ed Devlin is managing partner of Devlin Capital. Ed, thanks for being with us.
Thanks for having me, Amanda.
Well, whatever I thought we were going to talk about, we do have to talk about the notion that there's a new world order and Canada is going to find its way in it, as will other countries. From the point of view of how people should think about investing and the markets and what happens, I know uncertainty has been kind of the headline over all of that now for a long time. What do you tell people who say, well, okay, what do I do with this information? What do we do with our investment portfolios in the face of so much unknown?
Yeah, there's a few things going on. I would say, first of all, I'm a little concerned about the amount of debt that's being issued in the G7, call it, including Canada. So, I think that long-term yields, do look vulnerable and could back up. So that's one thing to be cautious of. The other thing, of course, is just how big the valuations are for these AI companies.
Yep.
So, one of the boards I'm on, we recently cut our position. The S&P 500, it's about 38%. If you just have a passive S&P 500, we moved to a cap product and knocked that down to 20%. So I think, being a little bit cautious and not putting all your eggs in the AI basket would probably be something that would be prudent.
Which is so interesting, Ed, because, there is a lot of uncertainty about what will happen because the U.S. is so unpredictable. But assuming that it's sort of like last year, economies were more resilient than expected. The IMF just actually raised the forecast for global growth because of that fact. And there's real optimism around AI and the way that it will actually turn into corporate profits. So in terms of what that might do, does that make the stock market another good place to look at in 2026?
To your point about the strong data, there's a lot of money that's going to have to be invested in data centers and energy to fuel this AI implementation. So literally, it could be trillions of dollars, to your point, can really drive economic growth in a number of countries. That being said, the business model is completely unclear. Revenues look like they might be more in the hundreds of billions. So if you've got trillions of dollars chasing hundreds of billions of dollars of profits, that looks like a recipe for a correction, but it may not be this year's correction. It might be down the road.
So people, of course, always have a fear of missing out, and that can catch people out badly. You talk about the late 90s. We all know what happened in 2000, major corrections. If it catches you at the wrong stage of your life and your need for growth in your portfolio, that's devastating. Would you say to somebody who's older and closer to a time that they can't afford a loss to get quite prudent here?
Absolutely, absolutely. If you're my age, unfortunately, then playing in AI stocks is probably, it's fine. A little bit is fun, but too much could be catastrophic. You probably want to start shifting towards more, dividend friendly stocks like banks. They're a bit more stable, will give you more income that you can retire on in a more predictable way.
Ed, we've got to leave it there. It's so good to have you with us.
My pleasure. Thank you for having me.
Ed Devlin, managing partner of Devlin Capital. Coming up, from housing data to inflation, the news looks pretty good until you dig in a little. Stay with us. Welcome back. Is there reason for optimism on housing affordability? Here's a look by the numbers. Housing starts in Canada rose 5.6% last year. It's the fifth highest annual total on record, according to CMHC. Starts were mixed, however, with strong showings in Montreal, up 58% year over year, and 12% in Ottawa, but decreases in less affordable places like Toronto, down 31%, or Vancouver, down 3%. And much of the starts momentum is from earlier in the year. The 6-month trend of starts is actually virtually flat. But December showed an upturn, with Toronto seeing an increase of 151% in starts compared to December 2024. That was driven by multi-unit builds. Vancouver also showed a gain in December compared to the December before, up 17%. Meanwhile, rate relief did arrive in 2025, with 5-year variable rates falling from 5.95% to 3.45%, and fixed-rate mortgages down from 5% to 3.85%. Those declines, combined with a drop in home prices, made buying more affordable in 8 of 12 markets, according to ratehub.ca. As for the year ahead, rates may not head much lower. Home sales are expected to rise 5% in 2026 in volume, and prices to increase 2.8%, according to the Canadian Real Estate Association. So does all of that add up to better affordability? There are some glimmers of improvement, but it seems we are far from out of the woods on it. Mathieu Laberge is Chief Economist and Senior VP of Housing Insights at CMHC. Thanks for being with us.
Thanks for having me.
So let's start with the headline that came from you of the housing starts number. Is it a good number? Do we feel like it's getting us to where we need to be?
Well, on its face, the 2025 was a good year for housing starts. They were higher than in 2024. But when you look under the hood and unpack what really happened, you have to reflect about what does it mean for 2026 now. As you said, the bulk of the acceleration in housing construction happened in the first half and up until the summer of 2025. But since December, the trend of housing starts has been consistently decreasing. And even though they inched up a bit in December, that was not enough to actually reverse the decreasing trend. Mm-hmm. And so that leaves us with, a start of 2026 from a point of weakness. Now, add to that, trade and geopolitical risks that are coming forward this year with, the review of CUSMA on one hand and the U.S. midterms on the other end. And you have, a recipe for some headwinds on the Canadian economy that would impact the housing markets going forward. Especially
because, Mathieu, I would imagine that moving the dial involves some of those multi-unit developments, right? The big ones that do a lot at once that's what gets you into the 151% year-over-year increase category. And those are the developers that, as I understand it, are kind of the most constrained right now. Any reason to expect a difference in that in 2026? Well,
what we see going forward, and you said it well, rental was a main supporter of housing construction in Canada in 2025. Now, our latest rental market report also showed that vacancy rates are increasing. Mm-hmm. Rent growth is decelerating, so rents are still going up, but at a lower pace. We still see that trend ongoing for 2026, up to a point where eventually the math won't work as well for rental either, right? So when we get at that point, that begs the question, what will sustain the market going forward? What will be the source of supply?
Yep.
What we've seen in 2025 is a shift towards rental and missing middle. We see that eventually over the next year or two, rental construction should moderate as well.
You know, I want to talk about those broad housing data from CREA because to me it feels a little Goldilocks, right? To say prices will basically they're saying the rate of inflation is what you're going to get in a home price increase, which is actually good for people who already own a home. They're not losing value, and okay for people that are trying to get in, although we'll acknowledge that they're still at reasonably high levels historically. Do you like that data in terms of what it does to affordability?
Well, when I think about affordability, you know, there's always two sides of affordability. Price is one, but income is the other. And if you want to restore past affordability, income has to catch up with not only the price increase that's coming down the road in 2026, but those that happen over the last several years. And that's where we see, you know, some room for improvement and where supply is needed to actually bring more moderation in terms of price and rent increases and help, you know, Canadian households find a housing that they can afford given their income. The economic landscape in that sense is something we need to keep track on because in an economy that's, you know, weaker with some headwinds coming, obviously income will be impacted. And so that means it may take longer to restore past level of affordability. So all in all, good news that, you know, the pace of growth of housing prices will moderate, but and still be positive. But you know, you also have to bear in mind the income side of the equation.
For sure, we got to leave it there, Mathieu. But great to have you with us. Appreciate your insights.
Thank you so much. Anytime.
Mathieu Leberge is Chief Economist and Senior VP of Housing Insights at CMHC. While inflation looks contained in Canada, it is still running hot in the exact places people can't afford, and that's especially true at the grocery store. Colin Mang is a professor of economics at McMaster University. Thanks for being with us, Colin.
Yeah, thank you for having me.
So, you know, you look at that food inflation number at 5-6%, and we know that for specific categories, it's double digits still. That's on top, of course, of huge price increases over the last few years. Is there anything that could be done? Because the blunt instrument of the central bank is targeting the overall number. What can we do about this price that really does hit affordability hard?
A big part of the challenge with food prices is it's being driven by supply issues. Here in Canada, I mean, we've started to solve the demand problems we've had over the past couple of years with the surge in population. I mean, that's now ended. But we continue to have supply challenges all throughout the food supply chain. When you think about some of these products that have really seen significant increases, take a look at coffee. Coffee is something that we just import. We don't make it here in Canada. Now, global supplies of coffee grew marginally in 2025 compared to 2024, but nowhere near as fast as global demand. And as a result, we're paying 30% more for coffee. If you look at something, for example, beef. I mean, we do make beef here in Canada, but because of the way the prices have moved over the past couple of years and because of some challenges for farmers on the prairies in getting feedstock for their cattle, they sold off a lot of that stock over the past couple of years. Our stock of cattle is actually smaller now than it was in the 1990s, even though our population is much, much bigger. And that's what's pushing up our prices for beef. So for a lot of these categories, take oranges, another example. Canada used to import most of our oranges from the United States. Now we only get about half from the United States. That's all they're able to supply us. We now get about 20% from South Africa, another 10% from Spain, and 9% from Morocco. All of that has to come across the ocean with the extra travel costs involved in that. So this is the kind of thing that's really pushing on food prices for Canadian families, is that we just have these supply challenges, rising costs of production, rising costs of transportation. Yeah. There isn't really a way around that.
And of course, people have taken up against the grocery stores. We've seen that in the past, that they get kind of blamed for profiteering. I think we know the margins are pretty thin for grocers, and so the passing on of costs is something they do. I want to ask you about a recent story involving McDonald's Canada, lowering the price of its value meal and a small coffee and holding it there for a year. I actually looked at this, Colin, and said, this is kind of a scary story because McDonald's is taking a hit to its profit because it knows customers can't bear it, which isn't really great for the economy. Would you expect to see more of that?
Yeah, I mean, I think you're absolutely right to note that retailing in general and food retail specifically is very, very low margin. The fact that Canadian consumers are really tapped out at this point. I mean, housing costs have started to come down in some parts of the country, but they're still elevated compared to where they were 10 years ago. Incomes have started to rise slowly again, and for some people, the increase in their incomes is starting to overtake inflation. But given that we had those big price rises over the past 3 years, it's going to be a while before Canadian families catch up to where they were about 5-6 years ago. When you start to see businesses concerned that customers are just not going to be able to come back and afford their goods, that is a really negative sign for the economy where we're heading. Once businesses start cutting prices just to try to maintain the customer base that they have, that signals that there's not a lot of business confidence in where consumer spending is going to be directed, and also that that businesses expect consumers are going to be really, really careful with their money.
So good to have you for this, Colin. Appreciate your time.
Yeah, you're welcome. Thanks for having me.
Colin Mang is a professor of economics at McMaster University. Coming up, a Toronto company recently became the first optical satellite network in space. Stay with us. Welcome back. Recently, Toronto space technology firm Kepler hit a key milestone with the launch of 10 near-Earth optical satellites, adding to 23 in orbit and creating one of the first space-based optical networks. Former astronaut Chris Hadfield is a spokesman for Kepler. He joined me on this week's Wonk podcast. I asked Hadfield about the significance of the launch.
It's a great story. Canadian company, as you mentioned, and just very recently launched 10 big satellites into orbit. The largest launch of Canadian satellites ever, 10 of them all at once. Each one of them is like 300 kilograms. And what they provide is laser communications in orbit, which is brand new kind of technology to be able to do that. And if you've got 10 of them, then they can all be communicating with each other and with the ground. So it's like we are moving the web to orbit. It's like we're moving the data centers to orbit now, and that Canada is doing it independently, completely homegrown, just a company called Kepler in Toronto here. So the company was born here about a decade ago. It's already got 20-odd satellites up. But boy, this latest launch really sets the stage for the future of independent Canadian commercial activity in orbit.
Kepler's technology will change the way information in space gets relayed. I asked Hadfield to explain how.
Yeah, think what it used to be with the internet, right? You would dial in and you'd get logged in somehow and you'd send packets back and forth. But this is at the speed of light, real-time communication all around the world amongst the satellites. And it's optical, it's lasers, it's not like radio waves. So it can be very high data rate. And because there are 10 satellites, at least one of them always is over a site on Earth where they can be downlinking information, either radio waves or with lasers. So it's as if suddenly we have extremely high speed, extremely high data rate capability for a constellation around the world. And this is independent of other countries' constellations like that. So that's a big deal. And we already have a bunch of customers either already on board or lining up to be on board for this constellation that Kepler just put up, including for human space flight. One of the follow-on space stations is already committed to using the Kepler web on orbit. But even things like, what if a little satellite up there detects the symptoms of wildfire on Earth? Well, what would happen right now is it would detect it and it would record it in its little memory. Then it would boop around the world until finally it came over some antenna on the world. And then it would try and downlink the information. Well, now those can be connected with our constellation real time, and you can get all that type of data. It's as if you took all the sensors now and are being able to put them together and giving them in a position where people could use them real time. So it's a big step, and I'm super proud that it's a Canadian step.
Space is opening up as a business opportunity. Hadfield says Kepler's launch is an important step.
I think the big change is the cost of launch has plummeted. It used to be really rare and special and like a superpower thing to be able to launch a rocket. Well, the technology, like everything else, has progressed. So the cost has come down. So now there's a lot more things that can be launched to orbit just by independent companies. And it's taken a little while for Canada to take advantage of that and to be in a position to really start using that capability. Kepler's leading the pack. And this step here is the most significant one so far in Canadian industry, Canadian commercial spaceflight. We've done, as you say, some amazing things. We were the third nation on Earth to have a satellite up there, and we've used it to communicate with big satellites stuck way out, so the Canucks fans could watch the Leafs play real time, coast to coast. But this is a big step forward just in raw capability. It's like a community getting high-speed internet for the first time, and it leads to a lot more things. So we're really looking at sort of a bellwether of what's coming.
That was part of my conversation with former astronaut Chris Hadfield from this week's episode of the Wonk Podcast. Time for the takeaway, and when it all feels a bit rich. The anti-poverty NGO Oxfam released its report on billionaires this week, timed to coincide with the arrival of the fleets of private jets landing in Davos, Switzerland. That annual gathering of the world's political and business elite had a renewed sense of urgency about it, coming as it does at a time when the world's superpower seems bent on destruction. But that might also make Oxfam's core message even more relevant. As a charity concerned about poverty, Oxfam can work itself up about the sheer existence of billionaires. That is, they condemn the fact that one person can spend hundreds of millions on a yacht, while 1 in 4 globally go hungry. Fair enough. But even those who would argue that great wealth isn't the problem and can be a source of motivation to create a better world for all, or even that those super rich are among the most charitable of us all, should take a moment to focus on Oxfam's message this year. While wealth discrepancy is still its core concern, it's the access to power that money now buys that is Oxfam's real pre-Davos agenda. And here we might all sit up a little. It's hardly a secret that in Donald Trump's America, having political power opens the door to easy money. This White House doesn't hide the way it enriches itself, but more subtle are the ways that rich people in general have power. That can be indirect in the way they finance a politician, or it can be direct. Billionaires are 4,000 times more likely to hold public office than regular citizens. It can come in the form of messaging, owning the platforms from social media to newspapers that shape the agenda. But however it comes, it's hard not to see that a few thousand people globally could shape the world we all live in. There are easy policy fixes for that, and some of them are in place here in Canada, where the wealthy have less obvious clout than in other countries. But less obvious doesn't mean none at all. My takeaway? Wealth inequality will always exist, but it's up to us to make sure it doesn't make us all less equal politically, too. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.